All right, don't forget it's the Friday opening bell special segment, and we have a very special guest for you to talk about what's next for Nifty, what's next for the markets, factors that you need to watch out for, themes that you need to eye for. To take the discussion forward, we're being joined by Dhiraj Agarwal, who's the Managing Director at Ambit Investment Managers. Morning there.
Hi, morning.
All right, thank you so much for taking out the time and joining us. Straight up, do you think there is more steam to this rally? Factors that you think can contribute to the incremental set of growth that could come through for the markets, and also factors that you think perhaps need to be watched out for?
So at this point, there's a little bit of a disconnect between macro and micro. There's a lot of macro optimism. The micro is slightly challenging, but the market is obviously looking more at macro at this point and hoping and expecting that micro will follow through. So on the macro front, the two or three key positives are, one is it's pretty much a given now that US will go in for rate cuts sometime next quarter onwards next year. The extent of the rate cut is the only debate, and not really if the rate cuts are happening or not. And if that happens, most likely RBI also follows through. So that's a meaningful positive after a string of rate increases and bond deals, which have become a bit of a worry for the market as recently as September, October. Second is after the state elections, looks like the general election risk is now pushed out. The consensus is that it should be a easy walk for the current central government. Third, the GDP print and all the macroeconomic print from India is looking very, very strong. Why I say there's a little bit of a disconnect between macro and micro is that it's not fully yet getting reflected in sales or revenue growth for listed universe. So Nifty revenue growth for last quarter was only 5%. The quarter before that was only 8%, despite the fact that GDP is growing at 7.5% or higher. And that's a little bit of a challenge that I think market may have to contend with going forward. For now, it looks like we're heading up.
Sorry, I couldn't catch that. You said for now it looks like we're having a?
For now, it looks like we're heading up because the focus at this point of time is more on macro as compared to micro. And macro risks are now at least pushed out by a few months. It's not in the near horizon.
All right. A point well made, actually. It's not the rate cuts, it's actually the quantum of rate cuts which will drive the markets further. On back of that, with respect to that, the theme rate sensitives. You have banks versus real estate index now. It seems to be doing well. PSU have been outperformers. Private banks seem to be catching up. And there you have the real estate index, which right now is sitting at a 14-year high. With all of these three in perspective, what do you like the most, and preferably why, the rationale behind this?
So number one is that real estate, if you actually see, is not really behaving like a rate sensitive in the current environment. Real estate demand didn't actually slow down despite some amount of interest rate tightness in our country, which has arguably been lower as compared to the US. But we have seen strong real estate demand right through. In fact, one of the primary drivers of credit growth of the banking system as a whole has been home loans. Home loans demand never really cooled off. It's always maintained at 17-18% in the last 3 or 4 years. So that is on its own steam. People are buying houses, especially the more premium homes, homes above 10 crores. As soon as they get launched, they get lapped up. Coming to banks have consolidated for the last 1 year, save and except a few names. Banking index has been a gross underperformer this year, up only 3% or 4% till yesterday. Private banks have been more so underperformers, and within the private banks, HDFC and Kotak, the two leaders have been almost like flat for a year and a half or 2 years. So simply by the fact that these stocks haven't performed, earnings have grown, valuations have obviously then come down, and market is looking at the next leg of momentum here. Plus, in some ways, the market likes to play banks when the interest rate environment is sort of coming off. So I think, yes, banks might get a little bit of a wind under their wings in the current environment.
Sure. What really surprises me here is the fact that despite the outperformance that we've seen from the PSU banks, the valuations aren't really still at a premium as compared to the averages. On the other hand, you have a bit of let's just say, relative underperformance coming in from private sector banks, and those still demand a huge premium as compared to the historical averages. Call it the fundamentals, call it the books. But this huge discrepancy within the valuation is something to write home about. What's your assessment?
It's converged quite a bit in the last 3 years. The gap between the PSU bank valuations and the private sector valuations used to be huge, let's say in 2019, 2018. It's converged a lot. Can it converge a bit more? Possible. Can't deny that because especially the large frontline PSU banks' performance metrics at this point of time look pretty much no different from the large private sector banks. Given the history of PSU banks, markets are always a little bit of circumspect in pushing the valuations up closer to the large private sector banks. I'm not saying it can't happen. It has happened in the past. 2003 to 7 cycle, SBI's valuation was reasonably close to to many of the private sector banks' valuations at that point of time. So it has happened in the past. It can always happen in the future, but it's a slow process. Confidence takes time to build. It doesn't happen overnight. And a lot of convergence has actually already happened in the last 3 years.
Well, point well taken there. But Dhiraj, what's next for the markets is a big question for all of us. Now that we've seen an early Santa Claus rally, we've seen perhaps things just working in our favor, right? Talk about macros, talk about now earnings profile, talk about the Fed move. Everything seems to be picture perfect right now for us. But going forward, what's the kind of growth that you're looking for the markets, at least in the run up to general elections? When do you think this trend can reverse, and what are the factors essentially that you could again highlight, just the 2 points that can lead to the reversal of this trend?
So 2 points I would say is to focus on once the US rate cut cycle starts, there's a little bit of a conundrum in the market at this point of time. Most people want 200, 250 basis points of rate cut without the economy slowing down a lot. Now that's a little bit of a conflicting situation right here, or oxymoron, if you may call it. I don't think the Fed will cut rates by 200 to 50 basis points unless the economy totally collapses, which is not good news. So I'll always say, be careful of what you wish for. So don't wish for very steep rate cuts next year, because that might actually mean a recession, which is not good news. On the other hand, if the rate cuts are only 50 to 100 basis points, I think the markets might be a little bit disappointed with that, at least in the short run. I'm more in the latter camp. I think rate cuts will disappoint. US economy will not slip down to that worse a level that will warrant a 200 plus rate cut. Inflation will remain on a higher trajectory as compared to what we have seen in the last decade. Obviously not as high as what it was a few months ago. So that is one risk which will cause some volatility around maybe April, May, June next year. The second one metric market will very closely watch is, will December quarter numbers show a meaningful jump in sales growth? So first half, while the earnings have grown by about 27, 28%, remember the sales growth has been only 6 or 7. And bulk of the earnings growth has come through margin expansion, as the WPI has crashed from a peak of 17 now down to nearly 0, or a quarter percent as compared to last print, which basically meant that the input costs for companies have crashed and the margins have really expanded. But we need revenue growth at some point of time. So I think Jan itself could bring in some volatility as the market digests whether sales growth is coming back or not. And by March quarter results, which is April, that can become a real risk. So come April, there are two large risks. A is the sales growth bouncing back, and B, a more granular view on how much the US rate cuts will be.
And what sort of percent of rally are you anticipating by March, April, ahead of the factors, or let's just say the skeletons from the closet start coming out?
Not really skeletons from the closet. I mean, see, there could be some more rally. It's always difficult to say, can the market go up another 5% or 10% or 7% before those risks start coming to the surface. So at this point of time, the momentum seems on the up. As we discussed at the beginning of this discussion, that banks haven't really participated in. Looks like banks are coming back. banks being more than 30% of weight in the index. If banks run, the index does well. So there could be a little bit more headroom on the upside. But from here, is it a huge upside before we run into some risks? I don't think so. Are we in a bubble zone? I don't think so. But I think we are in a fair valuation zone at this point, some more upside maybe as the underperforming sectors catch up. So, yeah, I mean, it's actually difficult to say whether another 5% or 7% is left in this leg of the rally or not.
Which is until
Possibly is.
which is until March that you think we can capture on to that 5 to 7% of gains in at least this leg of the rally, right?
Yeah, I mean, don't hold me to the exact date and month, but could be somewhere in
That's
that zone.
exactly, we're just
Yeah.
joining the dots out there for you in that case. But one,
Yeah.
speaking of underperforming sector that you just made a mention of, IT through and through, that you can think about is IT. It's been through two consecutive sessions that finally we are seeing some signs of perhaps momentum building up for the stocks, but fundamentally looks like the story still remains the same. Most of the analyst community that I have been speaking to says that this quarter also expects don't expect any big surprise on the, at least on the positive side from the IT names. With that kind of narrative that is building around with the IT stocks, you think right now it's the time to actually go out and venture into a category or theme like that, or you think you're still going to be on the sidelines, perhaps waiting for the sector to completely show some signs of recovery and then to jump in?
See, IT, I don't think December quarter matters at this point of time. I don't even think March quarter matters at this point of time. What matters is FY25 outlook. And FY25 outlook market is divided in terms of views. Half the market thinks that FY25, because the US economy is expected to slow down, whether it goes into recession or not, FY25 will also be a weak year for the IT sector. Whereas the counterpoint is that after FY24 weakness, FY25 will see a rebound. Not too sure which way it will finally sit. I mean, the recent bounce in IT sector that we are seeing is more to do with Nasdaq rallying, and IT tends to, in the short run, follow Nasdaq. So rather than any change in view in terms of business outlook. I think the commentary from December quarter results as to the outlook for calendar 24 is going to be very, very crucial for IT, whether the rally sustains or whether it was just a catch up with Nasdaq kind of a pump.
Also, what I'd want to understand is, since most of the IT firms are, of course, export oriented, with the rate cuts now being the big theme and the narrative that the market is buying and perhaps even a little bit excited about, how do you see that playing for the IT names?
By itself, the rate cuts doesn't really, I mean, fundamentally, it should not impact IT, right? I mean, where it impacts is rate cuts pushes Nasdaq up, Nasdaq goes up, IT goes up. So one can perhaps slightly wrongly conclude that because of the rate cuts, there is a positive macro impact on the IT business. I don't really think so. What will impact the Indian IT business profile is how does the US economy do? Whether it's a little bit of slowdown and then a bounce back after that, or whether it's a deep slowdown. And which is what I mentioned a while ago, right? Be careful of what you wish for. So if you're wishing for 250 basis points of rate cuts in the US, also implies that you're perhaps wishing for a recession in the US, which won't be good for the IT sector.
That's exactly
I'm
what
not
I
in
was
that
trying
camp.
to make a point on, where, it's not the rate cuts, it's actually the quantum of rate cuts which will decide whether the macroeconomic situation is intact for US or not. With that in perspective, can you just highlight for us that you think right now we should wait and watch for IT names before a full bounce back would happen, and or maybe just some signs of recovery could take place?
That's a trickier one. See, depending on what you're playing for. If you're playing for a short-term momentum, the momentum in Nasdaq is very strong. So can you make 5-10% return in IT from here on? Playing that theme or playing that trend, it's possible. It's possible. So I also run a long short fund, and we have some IT longs out there. But that, I mean, I'm being very honest. We're just playing momentum there. We're not trying to take a call on what happens in FY25. But yeah, because of US rate cut expectations, if Nasdaq is going up and it's pulling IT up, why shouldn't I participate? So that's one short-term point of view. Long term, I would say it's still not clear whether IT business growth revives strongly in FY25 or not. So I think the risks are quite high out there.
All right, Dheeraj, pessimist as you may call it, but valuations, do you think that is a bit of concern given that now we are at the peak where, of course, the rally, we're witnessing this rally and there is a flurry of IPOs which have queued up. Talk about QIPs, talk about fundraising, talk about block deal. Do you think there is a sense of bit of exhaustion within the markets on account of this? Do you think we're kind of overplaying ourselves a little more with the kind of rally? Do these kind of lineups that we've seen when it comes to the fundraising, does that worry you at all?
It does to some extent, but one thing I must point out is that historically, a spate of IPOs was considered to be a sign of a top in the market, and it has worked very well in the past. And I'm sure, along with some great quality IPOs, some poor quality IPOs slip in. But one big difference about the current IPO cycle as compared to at any point of time in the history is there is a significantly decent percentage, a large percentage of the current IPOs are actually fantastic companies. Now, one can argue about the valuations at which the IPOs are coming. One can argue about the short-term ebullience or short-term excitement about the IPOs. IPOs are doubling on listing within a week's time, etc. One can discuss and debate some of those aspects and nuances. But as compared to at any point of time in the past in history, many of the IPOs are actually good quality companies. Many of these are first-time entrepreneurs who have actually started their companies with the help of venture and private equity capital. And private equity and venture capitalists have actually helped the entrepreneurs in putting systems and processes in place to become larger and scale, etc. So it's that I think is a fantastic trend change in India. That early stage risk capital is available, which is giving new entrepreneurs access to capital to actually build their new ideas, and some of those, a large number of those companies are coming to the IPO market. The second big change as compared to at any point of time in the past is historically, the domestic pool of money was quite small and inferior, and we always depended a lot upon the offshore inflows for equity markets. This now domestic inflows are significantly larger than offshore. Domestic institutional ownership of the market is almost similar now to that of FIIs, and that's the secular trend in terms of a larger percentage of household savings going into equities, and which is what is absorbing the IPOs. Otherwise, this kind of a paper supply at any point of time in the past would have actually derailed the markets.
Point well taken. Clearly looks like it is a liquidity driven rally, but there is a market outlook. One last question that I'd like to squeeze in, and perhaps just 30 seconds on that one if you can. Markets outlook for 2024, that's essential. And also, what would you advise to our viewers how to play markets like this in the next year?
So I'll answer the second question first. It's an easier question. In this rally, especially in the last few months, everybody has become a fantastic stock picker because everything is flying, right? So environments like this, it's very difficult to differentiate between a fundamentally driven stock picker and just throwing dartboards and picking stocks wherever the dart lands. That will perhaps change in the next year. From this point on, markets will slowly start becoming more discerning, quality focused, earnings focused, and corporate governance focused. So everything is flying will, I don't think, repeat for through 2024. So that's my advice to the investors, that this is time to start becoming selective. This is time to actually looking at your portfolios if you're a direct investor, or your asset allocation if you're investor giving money to investment managers, to look at the composition of your portfolio and make sure it's balanced. It's more leaning towards quality as compared to just momentum and whatever is flying. Now, the second question, it's the answer was actually there in the first question itself. That 24, I think the markets will be tougher as compared to 23. We will see bouts of volatility in the market in 24, and which is what is required to actually separate the wheat from the chaff. So the good quality and the bad quality will start getting differentiated because the markets will turn volatile. I think the US rate cuts extent will disappoint the market, causing some volatility around the second quarter next year. I can see that the demand at the bottom of the pyramid level in our economy is still weak and not really recovering. So I think the sales growth for our listed universe is also likely to disappoint over the next 2 quarters, which will also bring in some volatility. And the benefit of the WPI crashing is either already in the bag fully or will be in the bag at best, by the end of December quarter. And hence the benefit of margins helping earnings growth will start going away from March quarter. That will also cause some volatility. So 24 is going to be, in terms of volatility, a tougher year as compared to 23. And the recommendation to the investors is be selective, start focusing on quality.
All right, completely insightful anecdotes there. Dhiraj, thank you so much for taking out the time and having this conversation with us. It was indeed a pleasure chatting with you.
Thank you so much.
All right, with this, it's a wrap and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us in the link at the bottom of your screen. And for rest of the day, stay tuned into moneycontrol.com and Money Control